Jerome Powell is about to begin his speech in front of the House, a House of Representatives committee, any minute now. This comes as the Fed chair faces mounting pressure from Washington, especially President Trump, to cut interest rates. Let's get more from Keith Buchanan, Senior Portfolio Manager at Globalt Investments. Keith, great to see you. Thanks very much. When it comes to interest rates, your take is that we're hearing noises from Fed officials they would like to see lower borrowing costs.
Absolutely, and thanks again for having me. Yes, we're looking at, taking news as it comes in the speeches and commentary from Fed officials, and it seems fairly clear over the last couple of days that's tended a little more dovish. And in order for the Fed to move down a path of more cuts than perhaps the market expects, or even two that the market expects over the course of the rest of the year, the scenario has to play where they have moved away from the fear of inflationary pressures from whether it's from what's going on with the fiscal budget, or as well as inflationary pressures perhaps from tariffs or the reaction of corporate America. All that's still kind of coming in. Information and data is coming in as we speak. So the commentary that's turned as dovish has been received well by the marketplace, but still yet to be determined how the overall Fed will approach the rest of this year, and that's what we're concerned about.
You're skeptical about earnings growth projections right now. You argue that tariffs are a crucial, maybe the crucial factor in corporate profits.
Absolutely. The market expects now 9% earnings growth for 2025 and another 13% earnings growth over 2026. And we keep looking back to where we were, this part of the year, everyone's doing the kind of mid-year look back. And we're looking back at where we started this year in the first quarter, where the market was gangbusters forward, pulling forward a lot of optimism about the new administration, whether it's less regulatory risk, more pro-growth policies from a trade and fiscal standpoint, and look forward to where we are now. The valuation that we traded at back then was just a hair higher than where we are now at 22 times next year's earnings, implying, again, significant growth from a historical standpoint over the next 12 to 18 months. But there are a lot more risks as we look forward from this point over the rest of the next of the year, particularly from the reaction of corporate America and how they deal with the ongoing changes in tariff policy, but also the fiscal situation as far as the budget and what question marks or even concerns or risks that poses as far as the debt load growing even further. And that's a huge concern on our parts from a secular standpoint. So we're very concerned with and cautious about where the market stands. Earnings growth we feel like it kind of is what it is at this point, 9 and 13% over next year. But the risk to the downside, we feel like, are not necessarily priced into the valuation that the market is trading at right now at 22 times. And that's what that disconnect was causing us some concern.
Are you in mixed portfolios or balanced portfolios? Are you inclined to cut your stock weighting right now?
We've been conservative when it comes to our equity position, particularly here in the U.S. and also internationally. And we are looking towards, a little more outside of equity and traditional fixed income exposure. We've added to a silver position. Also, we have a significant gold position that's boded well for our performance over the last 12 months or so, particularly. So we're comfortable there and having non-correlated assets that if the fixed income market does continue to perceive our debt load as being problematic, the treasury market, especially the long end, could hang up with these higher rates for a longer period of time. That puts more pressure on the fiscal situation. So that cycle is what we're more concerned about. And that also poses a risk for equities, as that cost of capital stays higher than the market now expects. But potentially that could be an overhang on returns for risk assets on the equity side as well. So we have concerns on both sides of the ledger. We want to be a little more diverse when it comes to that. And also, having those hard assets really, we feel like benefits our clients going forward.
What about the Mag 7 stocks, the tech giants? Do you have a view, broadly speaking, on those?
If interest rates stay as high as they are now, and perhaps even, could stay in this range for a little longer than the market expects, that puts pressure on that discount model that those longer term earnings and cash flow that are discounted to now, those are somewhat susceptible to higher rates for a longer period of time. Not that their business model is in any way broken. We feel like the push towards artificial intelligence and that being integrated into almost every phase of our lives is almost inevitable, and the speed at which that happens, and also the earnings that could come from that. But just from an environment that benefits growth over every other asset class, that hinges on rates moving lower over a longer period of time. And we're not necessarily convinced that that's the base case and what the market, at least the information we're getting, and as far as how we see the world, is offering into our perspective of the risk assets landscape over the next 12 to 18 months. So we're concerned about those stocks in particular, and how they, not how they perform from an earnings growth standpoint, but how the valuation can continue to grow over a period of time when the interest rate puts pressure on those valuations at this current level.